Hi everybody, it's AJ speaking. This is a deep dive into Tesla's third quarter results. But before we get into the numbers, I would like to point out something about the share price reaction. So this is the share price right now. Stock trades in pre-market at $447 per share. It's Friday, 24th of October. That means we are now one full trading session after the release of the numbers. And you can see that the stock yesterday closed at $448 or almost touched $449 and was up 2.3%. Now I switched to a screenshot which I took during trading hours that shows you the last 5 days, and it shows you yesterday's session. So the stock was temporarily down more than the 3.5% that you see on this chart. It actually touched briefly $414. I couldn't take the screenshot at that time because I was busy buying stock. The reason why I'm pointing this out is you can see the significant swings that can happen post earnings. This quarter was a perfect example. As quite often Tesla's number in the first moment get misinterpreted, and then investors who look through the numbers quickly buy stock. And later in this presentation we will see what actually apparently confused investors and why actually the numbers were much better than what they apparently first thought. But before we move on, I'd like to show you real quick the last quarter. So this is the share price reaction upon release of the second quarter results. You see there was a massive sell-off. This sell-off was caused by Elon saying next quarters could be rough. I just want to remind you of that because had you bought that dip, phenomenal return, because you would have made 40% basically roughly, or 35% in as little as one quarter. The critics might say, oh yeah, but this was driven by Elon's Tesla purchase. Yes, they made a big impact, but before the market knew there was a big buyer in Tesla stock, and algorithms can pick up on that. That day, if you run a proper analysis, you can see the stock was already at least at 380. So still awesome return from 313. And also important to keep in mind, at that point in time, that was July 23rd. So here's the date up here. At that point, the end of the tax credit in the US was known, and it was also known that credit sales would go away. So in theory, investors could have priced in all of that, but despite knowledge of all these negative factors, stock traded up quite substantially. And I think here's a key lesson for every investor, whether you're retail, institutional, or otherwise. Even if at the beginning of the quarter things look very dark, you should not underestimate the strong sentiment in the stock that even if the PE multiple looks really high, will still drive the stock if there is a little bit of improvement. And that little bit of improvement were quite strong sales this quarter, even though in terms of earnings, that didn't make a huge impact, as we will see later. So the key takeaway here is that in Tesla, even though it's very important to have a clear picture of the fundamentals, the sentiment aspect about the stock is much more important. And whether you think Tesla is overvalued on a classical valuation method doesn't matter, because ultimately the only one who is right is the market. So with that out of the way, so let's look at the numbers. Revenue hit an all-time quarterly high. Revenue came in at 28.1 billion. That was up 12% year over year. And after the first 3 quarters of this year, Tesla brought in just under $70 billion. That is up 3% year over year. And by the way, if it's the first time you've seen one of my slides, here on the right-hand side, you have here the relevant financial statement for the item we're discussing. And so, for example, here you have Tesla's income statement, and we are discussing total revenue. This is mostly to help people navigate financials. I think revenue is probably quite easy, but there are some more obscure financial metrics where it can be quite helpful for people to see where we are in financial statements. In some cases, if it's not a financial metric directly disclosed in the financial statement, I often show the line item that is most affected by whatever we discuss on the slide. So just for clarity. And one other note before we move on, the percentages that you see up here, they're always growth rates, and the underlined percent is always the year-on-year, and the other percent number that is not underlined is the quarter over quarter. In general, you want to look at the year over year because every business has seasonality to some degree. Next, I'd like to introduce a new metric which we can derive from Tesla's SEC filings. Tesla does disclose cumulative miles driven on FSD. By looking at the change from quarter to quarter, we can derive how many miles were driven in a given quarter. And in the third quarter, if we do this exercise, that number was 1.21 billion miles. And that is up 145% year over year. And the reason why I'm discussing this here right up front, right after total revenue, and while I still mark revenue here, is because I think going forward, this is a useful leading indicator for FSD adoption, which I believe will become in 2026 an increasing part of the story. There will not be a massive earnings impact just yet in 2026, but it will, I think, attract a lot more attention. And I think this metric, and specifically the metric I'm showing on this slide, average miles driven per day in a quarter, gives us a good view in terms of the adoption rate of FSD. And I'd like to highlight that, for example, in Q2 24, there was, for a certain one-off effect, a significant spike in FSD utilization. But the software at that point was, even though it was quite impressive, it was not at a point where it was truly useful to enough people. And that's why after the, let's call it the early adopter and test phase pop, utilization quickly decreased. But what we can see in the most recent trend is that there's quite a strong uptick. And I think the latest quarter not only benefited from increasing maturity of the product, but of course also by geographic expansion. However, I think geographic expansion contributed a smaller part. So basically, even though we cannot separate these effects, overall I think the trend is very strong, and that bodes quite well for greater FSD adoption going forward. Although I think this is widely assumed, adoption keeps increasing, but I think it's good to always test the numbers, because as you can see in this trend, there were a number of quarters where, at least in my perception, in the Tesla community, there was the myth of meaningful increase in adoption, but this data does not support that claim. So next, let's look at the main segments. So first we look at automotive revenue. So automotive revenue includes sales from vehicles or vehicle sales and automotive leasing. The two combined brought in $20.8 billion. That's up 8% year over year and is up 28% quarter over quarter. The main driver of this quite substantial auto revenue increase you can see on this slide. This shows you vehicle sales. Vehicle sales increased to 497,000 vehicles, and that is a new all-time high, as you can see. And it's good to see that this already happened in a third quarter, because typically the fourth quarter is the strongest quarter in a year, and this is primarily driven by a very strong seasonality out of China. But of course, this year we had a large one-off effect in the large US market. A lot of buyers tried to get an EV before the end of the tax credit. I will discuss the effects for the fourth quarter and the first quarter in very much detail in my upcoming outlook, because this presentation is only about the third quarter. So, but of course, not only volume is decisive for auto revenue, but also average selling prices. And average selling prices decreased slightly, and more specifically by 0.7%, so that's not very much. You can see up here in the first row these percent numbers, and you can see after the first quarter of this year, which saw a 2% year-over-year increase and a 7% year-over-year increase in the second quarter of 2025. That is the first decrease, but a very modest one. So overall, I think that's a pretty good performance, since the price war in the global auto industry is still quite fierce. Next, we look at regulatory credits. So this is a very, let's call it contentious topic. We can see that regulatory credits dropped to just 417 million in the third quarter. And you can see this is like a multi-year low. You have to go back all the way to the second quarter of 2023 for a lower reading, although there have been 3 quarters that were almost similarly low. I think what we see is a return to the new baseline after credits were dropped in the United States. So I expect going forward a similar level quarter over quarter, but no further decreases. And just as a side note, this reduction is basically exactly in line with my expectation. It was always estimated about 40% or so of credits, 40 to 50% would go away. This is basically what we now see in the numbers. And the primary reason is that Tesla earns in a number of other significant markets also credits. And I'd like to point out the comment the CFO made on this week's earnings call. He said, while regulatory credits declined sequentially, we entered into new contracts and continued delivery on previously entered contracts. So that's positive confirmation. But of course, regulatory credits hurt or they're lost because they're 100% gross margin revenue. So the correct way to look at them to get a better sense of overall impact is that you look at the gross margin of the business, which is 18% for the third quarter. Let's round it up to 20% for easier math. And then you divide the loss of credit sales by 0.2 for basically 20%. If you do this math, you basically scale up the credit loss to a revenue number that has a gross margin comparable to the rest of the business. This math is slightly flawed because the 18% I just gave you does include the credit sales we still have in the business. So let's assume 15%. So you divide the loss of the credits, and let's say a full US credit would be, let's say, another 400 million. So the math would be 400 divided by 0.15. That would be 2.7 billion. But this 2.7 billion might still not really bring home the point how much this credit sales loss meant. If you turn this into, how many vehicles would Tesla have to sell? You can just take this number, 41,000 was the average revenue per vehicle, and divide the 2.7 by 41,000. And the result is around 65,000 vehicles is what the loss of US credits meant for Tesla in terms of a gross income loss. Next, we look at Tesla's energy generation and storage revenue. So this is almost entirely driven by Tesla's battery storage. There's at the moment very little solar, even though Tesla mentioned there's right now quite a surge in the US. But we'll have to see whether Tesla returns to disclosing installed solar capacity as they used to do. But for now, we don't have that. So we can just look at the total numbers, and the total number is up a staggering 44%. And this segment almost touched 3.5 billion, came in at 3.4 billion in the third quarter, and was up 22% quarter over quarter. And also importantly, I'd like to point out over the last 12 months on basically annual equivalent, that business now brought in 12 billion. The primary driver of this 44% year-over-year revenue increase was a massive increase in deployments. Deployments were up 81%, but you can see already kind of a little problem here. So deployments were up 81% to 12.5 gigawatt, but revenue was only up 44%. And that speaks to things that Tesla said on various earnings calls. Competition in the global battery storage space is increasing very quickly because a lot of other companies have recognized there's a big opportunity. But as we see in a second, this obviously has not yet at least left a big mark on Tesla's financials. And this can you see here on this slide, gross margin hit a new all-time high at 31.4%. And let's just pause for a second. 31.4% is crazy for basically a hardware business that most people consider a commodity. And I think what we see in here is that number one, there's huge demand, and number two, of course, I think part of it is that the buyers probably must be scrambling to get product, otherwise, or there's supply shortage, otherwise Tesla could not generate this margin, because ultimately this is supposed to be a commodity, and commodities are not supposed to have like 30% plus gross margins. And there's one other important factor I'd like to point out. The CFO commented that Tesla had a tariffs-related negative impact of around $400 million, and he said this was half auto and energy. So Tesla delivered a 31.4% gross margin despite the 200 million COGS headwind. So in other words, the strength of this business is right now slightly clouded by tariff headwinds. And Tesla told us on the call, and we know from other sources that Tesla is already trying to mitigate these tariffs. So the bottom line is, even though the margin might erode, right now it's eroding from a really high level. And because the margin is so high despite the tariffs, which Tesla is mitigating, we have basically the margin erosion from competition less an offset from mitigating tariffs. So this would suggest that margin might stay high, probably not as high as in the third quarter, because that would be like almost ridiculous. but this is really, really attractive because this is a business that's growing really, really quickly. And what you have to keep in mind, this business right now has more than double the gross margin of the auto business. The auto business, excluding regulatory credits, has only 15.4% gross margin, which by global automotive standards is not terrible. It's not great either, but it's okay. But compared to energy, it's less than half, because as we just looked at, energy was more than double at over 31%. So the key takeaway is that margin right now makes every dollar of revenue generated in energy twice as valuable. So now if we go back to auto, we can see or near all-time high auto revenue, 20.8 billion. So keep that number in mind. Then energy storage is, in comparison, a relatively modest 3.4 billion. But in terms of financial effects, in terms of gross margin contribution, that 3.4 billion is worth almost as much as, or roughly 7 billion in auto revenue. Because auto is 28 billion and this is the equivalent of 7 billion. That means that the energy business has, in terms of gross profit effects, reached 1/4 of the auto business. But there's more interesting stuff, so let's move on. So this chart shows you the average revenue per kilowatt hour deployed. The way this is calculated is I made certain assumptions from historic disclosure and other things to strip out the solar business from Tesla's storage business, energy storage business, to then derive an implied average revenue per kilowatt hour deployed. And you can see that that number stayed fairly stable. It decreased sequentially. I think the primary driver for this sequential decrease is that we see first sales of Shanghai packs made, mega packs made in the Shanghai factory. And I think Tesla will be selling those at probably slightly lower prices. And that will have a dilutive effect on the overall global average you see on the slide. But overall, I think this pricing is still very strong. Just as a little side note, anyone who is interested in a company called EOS, it's a battery storage company in the US. I recommend compare this number with the implied number from their disclosure. What you will see, that cost is very close together, but Tesla makes a huge margin. In other words, if Tesla would compete against them, Tesla could bid at their price. But this presentation is not Tesla versus EOS. So let's move on. Next, we look at the services and other segment. So this segment captures all the rest of Tesla's business. So this includes used vehicle sales, paid supercharging sessions, Tesla's insurance business, merchandise, part sales, service. And this is also where Tesla books the current, probably minuscule revenue from the robotaxi network. And what's interesting about this is, first of all, it's growing quite quickly. It was up year-over-year 25%. This is quite an acceleration. That's the fastest rate since the fourth quarter of last year. So this is looking really good. And you can see this has been a very consistent growth driver. This has always grown sequentially, with the sole exception of the first quarter of this year, where it was down 7%. And then there was one quarter, this is not a typo here, where it was literally flat. These numbers look like typos, but they are not. And this business too just exceeded 12 billion in revenue over the last 12 months. So also quite massive part of the business now. And this is, I always call it probably Tesla's most predictable business. It used to get very little attention because the margin was quite low, but things have changed quite a bit. So let's look at the margin. So the margin came in at 10.5%. So this is gross margin, of course. And that's an all-time high, as you can see. In quarters not shown in this chart in prior years, this was mostly loss-making, because at that point Tesla's fleet was simply too small. So now let's look at what management said actually happened, because in the disclosure, unfortunately, we cannot really see what was driving this. For that, the disclosure is not granular enough, as is common for other companies as well. So the CFO said improvements came primarily from our insurance and service center business. And what's interesting, he also said that our robotaxi costs are included within service and other. I think it's obvious that they would include it here in let's call it S&O segment. And right now, because there are people sitting in every robotaxi to monitor, I don't think they make any gross margin right now on this service. because there's also a depreciation of these vehicles accounted for. It's not only on a cash basis. So the point is, despite the headwind of the current robotaxi network, the margin reached all-time highs, so it's very positive. So he talked about the insurance business, and just for your background knowledge, typically when financial professionals talk about key drivers, that's the kind of the industry standard amongst professionals. You talk about things in sequence of importance. So if the CFO stuck to that, let's call it unwritten rule, that would suggest that the insurance business was the most important driver. Unfortunately, there's very limited information on that part of the business. But if I had to guess, they likely started to use AI systems to improve the underwriting, as have many other insurers started doing in US. So, and what we see might be sort of the first fruits of that effort, along other improvements like service center profitability and probably some other things. However, I do expect that that margin will come down because they say it's driven by the insurance business, and that quarter tends to be one of the best quarters in the auto insurance space, because first of all, it's the quarter that has is one of the 2 quarters with the most light. The days are the longest. Then there is the least risk of bad weather like snow, ice storms, etc. So we are about to enter the winter quarters, Q4 and Q1. So I expect in Q4, as weather becomes worse and as daylight hours reduce, I expect that car insurance claims will increase. And therefore, that margin will likely come down. And if, for example, if we look at prior years, for example, in last year, we saw like a similar pattern. We reached a low in 2024 in the first quarter, so a winter quarter. Then it improved in the summer quarters, or let's call it the nice weather quarters. And then in the fourth quarter, it dropped again. A roughly similar pattern we can observe in 2023. But here, keep in mind, insurance had a smaller impact because it's quite in its infancy at that point. But we'll see in the next quarter whether I was right. If I was right, we should see that margin come down. If I was wrong, then it should stay at that level or even increase. Or there can be other reasons, and we'll never know. So this chart brings everything together in terms of revenue growth from third quarter of last year. So this chart is a year-over-year observation. So in the third quarter of last year, Tesla brought in 25.2 billion revenue. This quarter, it brought in 28.1 billion, all-time high. The primary revenue driver was the auto business, increased year over year by 1.5 billion. Second was the energy business, increased by just over 1 billion. Then also the services and other segment developed positively, bringing in plus 0.7 billion. And then there was a loss of around 322 million in the credit sales segment. I know a lot of my listeners, they're more interested in the quarter to quarter, and this is what this chart or this bridge shows you. So in the last quarter, revenue was at 22.5 billion, and then this quarter, the substantial increase in vehicle sales added 4.6 billion in revenue. Regulatory credits were basically mute. They were at a very similar level. So the third quarter only saw a reduction of 22 million, so there was no major impact from regulatory credits quarter over quarter. It basically confirms what I said last quarter, that the effect of credit losses were already reflected in the second quarter because customers of Tesla buying these credits or other automakers anticipated that Trump would kill the credit sales because Trump talked about it. And that's why they were likely highly cautious, because keep in mind, we're talking about hundreds of millions of dollars here, making new contracts with Tesla. And that's why we saw the full effect already in the second quarter. And that's why you see now marginal change. And then the other driver was the energy generation and storage segment, up 626 million, and the service and other segment up 429 million. Next, we move on to the cost side. So first we'll look at average weekly production cost. It's always a very important metric that's driving Tesla's earnings. We can see production cost went down a little bit. Cost was down by, call it $400. And Tesla managed to do that even though, as we learned from the CFO, there was about 200 million of tariffs-related negative COGS effect. So COGS is short for costs of goods sold. This is what you're looking at. So Tesla's cost of goods sold for a car was on average $34,900. And I estimate that the tariffs added about $402 on average to all cars in the third quarter. But of course, tariffs only affect US production. So if you only run this calculation on US production, it would have been about $1,158 per vehicle. So that is quite a blow, but the big item that helped to offset more than the tariffs was actually the fixed cost absorbing effect of increases in volume. And the way you can think about it is very simple. Tesla has in the auto business approximately 1.2 billion depreciation. That depreciation number is a fixed amount because it's depreciated on a straight line using the straight line method. So it doesn't matter whether Tesla makes or sells 400 or 500,000 vehicles, the depreciation charge is always the same. So if you then calculate a average vehicle cost, you account for the volume. So because this fixed charge stays the same as the volume goes up, the implied cost associated with that goes down. And I estimate the substantial volume increase from Q2 to Q3. And you see this here, we moved from just 384,000 vehicles to 497,000 vehicles. So that's 113,000 vehicles more. That provided a fixed cost, or at least this depreciation charge absorbing effect of about $700 or $720 per vehicle. And since the tariff effect was only $402 per vehicle, Tesla had a benefit of an excess absorption of about 300 over that cost. And then when you look at this change in vehicle production cost, so you have to keep rounding, etc. in mind. So here's a delta of rounded $400, which is pretty much in line with the delta between the implied tariffs impact and the fixed cost absorbing effect. So some of you might be thinking right now, oh, but what happens in the fourth quarter? U.S. market will significantly decrease because the tax credit is gone, blah, blah, blah. This is something I will be discussing in great detail in my outlook. So stay tuned for that. I think there are a lot of things people, I think, not necessarily have on the radar, unless they follow me. Just a shameless plug. And next, we look at an increasingly important cost factor, which is the cost per kilowatt deployed. So that number came in at $187 in the third quarter, which is very similar to the first quarter of this year. Here again, important to point out, also about 200 million of additional COGS were created because of tariffs. And because that segment is overall much smaller than the auto segment, tariffs have in this segment, and this is also what the CFO pointed out, a much bigger impact. So despite the quite sizable tariffs effect, Tesla was able to offset the impact, as you can see, by a still low average price or a no material increase. And you can see the cost came down actually 7% quarter over quarter. And I think the way this works is as follows. So the second quarter already saw a bunch of tariff-related costs. So prices increased, but the Shanghai Megapack factory that produced at a much lower cost was just ramping in the first quarter, and then their product reaching market and being booked takes a number of months. So we probably saw only very little or almost no Shanghai product in the second quarter in this number. And now the first and lower cost product is hitting the quarter. And I think this helped dilute the price down despite the cost increase in the United States. And as we learned on the call, and it's obviously anticipated, Tesla is already working probably feverishly on offsetting the effects of the tariffs. For example, we know that there's a brand new LFP cell production line kicking off in the first quarter in the United States. So next we look at total gross profit. Total gross profit came in at just over 5 billion. That's a multi-year high, as you can see here. We have to go back all the way to 2022 to find a quarter with a higher gross profit. That's very positive. I'd like to point out one warning that Tesla gave us on the second quarter call, and they said, given the latency in manufacturing and sales, the full impact will come through in the following quarters. So costs will increase in the near term. We are in an unpredictable environment on the tariff front. What was the net result? Margin improved in auto, margin improved to all-time high in energy storage. I think the key lesson we can learn from this, you always have to take Tesla's warnings with a big grain of salt. I think they are maybe over preparing the market for bad news. So it's always important to compare what was said, what happened, to basically calibrate your expectations. This pays huge dividends in terms of your forecasting ability. For example, if available, always look at management guidance and compare what they said and what was delivered, while taking into account factors which they could not have known at time of guidance publication. But before we move on, the naysayers, of course, will say, oh, gross profit is only up by 1% year over year. Sure, but this ignores all the headwinds that we saw in the third quarter. One big one, credit sales decreased a lot. Second one, over 322 million, as we saw. A second one is that we had 400 million of tariffs-related costs. So that's all the direct hit. So that's right, 700 million right there. If we adjusted for all of that, we would be near or maybe above all-time high gross profit. So next we look at the all-in headline gross margin. That's 18.0%. That's the strongest margin since the second quarter of 2024, if we exclude the third quarter of 2024. And the reason why I would recommend to exclude that quarter is because that quarter was full with quite substantial one-off items, and therefore kind of pollutes the trend we can see in this time series. That quarter saw, just to name a few of the one-offs, there was a very large credit sales recognition, I think over 700 million. There was the recognition of the FSD release for Cybertruck. So all the people who paid up front, etc., for FSD, and probably a lot of Cybertruck buyers bought FSD because it's a very expensive vehicle. So these are people that can actually afford a large software package as well. All that money then was, or a significant share of that money was recognized at time of release, because then a big part of the performance obligation was fulfilled. And that quarter also saw the Smart Summon feature release, which then also released more FSD revenue from the honeypot. The honeypot is Tesla's roughly 3.8 billion, 3.7 billion deferred revenue on the balance sheet right now. That there were a few other things, but the bottom line is there were too many one-off positives, and you need to adjust for them, and then you realize it was actually significantly not as good. And that's why it's a bad comp to compare the current third quarter with. And I think this is still an area where humans can have an advantage over algorithms, because they are often trained on a lot of data that looks, or year-over-year comparison, etc., which is very classic on a lot of data. But they may not be as sophisticated enough yet to account for all these, let's call it, secondary and tertiary factors that need to be factored in. Next, we talk about Tesla's famous auto gross margin, which certain Tesla community characters like to bang on about. So that margin improved to 40.7%, and that famous auto gross margin is the one that is calculated excluding leasing, excluding regulatory credits. And the reason why you exclude regulatory credits, because as this year showed us, they can go away very quickly if politics change. And that's why you want to look at what's the underlying gross margin of the business. And then the reason why you want to exclude the leasing business is, first of all, the leasing is accounted for very differently than an outright auto sale. Tesla's leasing share is very similar to other automakers. However, that doesn't directly affect Tesla's numbers, because Tesla's leasing is mostly done through third parties. And there's a very small leasing share that is actually facing Tesla. And that's why Tesla reports very low leasing share. Overall, it's not really a needle mover, but you get cleaner numbers if you extract leasing business. So when we now look at the trends, it's good. We see quite an improvement since the first quarter, but this is not an accident. This volume, this fixed cost absorbing effect from larger volume makes a big difference to this margin. But again, there was also the tariffs related headwind. So net still very good that we see this improvement. Just for completeness, I'm showing you the auto gross margin, which just excludes the regulatory credits. That's 50.4%. And then we have the headline auto gross margin, so that includes everything that's associated with this auto, and that's 17.0%. That's a slight decrease. And this basically makes exactly my point. We see here a decrease, even though the underlying auto margin has improved, as we just looked at. Also, the auto and leasing also improved. And the reason why we see an auto margin decrease is because we have fewer credit sales. And this decrease, if we just look now at this margin, would imply sort of a weakening profitability in the underlying business, which is in fact not the case. The opposite is the case. And that's why it's so critically important that you clearly understand how a number was calculated and what is and is not included in a number. I'm skipping over energy because we already talked about the gross margin energy. We also talked about the gross margin in service and other business. So this chart then summarizes the gross profit drivers if we compared this year's gross profit with last year's. So there was, as we talked about, there was only a very small increase of 1%, but there were a number of headwinds, and this chart captures those headwinds quite well. So this year's gross profit saw a 322 million headwind from lower regulatory credit sales, and you can see this was by far the biggest factor. Then the auto business, despite what you hear from a lot of channels, and for example, if you read Reuters or some other mainstream media, you think like Tesla's business is collapsing. We can clearly see here in the numbers was actually not much of a change. Tesla lost 94 million in gross profit year over year. This is very little given what's going on in the global auto industry. So Tesla does exceptionally well in auto given the environment of the market. And then we can see that the energy segment compensated not only for the credit loss, but even partially for the slight reduction in auto, and the rest of the auto reduction was offset by the service and other segment, which then led overall to a modest increase. In a couple of quarters, once we see the ride-hailing network broken out in Tesla's disclosure, and once we see Optimus broken out, this analysis will become very, very interesting. So I can't wait doing those charts. Now, just for completeness, we look at the same chart again, but this time on a quarter-over-quarter basis. So auto, massive increase, plus 774 million. Here again, regulatory credits created a small headwind, as I said earlier, because the effect from US tax credit sales loss was already reflected in the second quarter almost entirely. And then auto leasing, a very small reduction. Again, this is the leasing part of the business, or the leasing business is facing Tesla, so not the third-party leasing business, which is not that relevant here. And then energy storage added another 227 million to gross profit, so it's an increment. And then service other also added 200 million. So overall, really great numbers. And this is also a big reason why I was very quick to take advantage of the dip yesterday. I didn't hit exactly the dip. The lowest part was, I think, 414. I bought on average all the stocks I bought around 417, 418. I'm quite happy with the 7% in less than 24 hours. And it was not only gross profit that convinced me. This was a good moment because also when we go further down in the income statement, we soon talk about operating expenses. There were a bunch of one-off items which made the number at first glance look worse than they were actually. Now we look at total operating expenses. They comprise of R&D expenses, or research and development. And the second big bucket is SG&A. That comprises selling, general and administrative expenses. And then the third big bucket is restructuring and other. Restructuring and other in oftentimes can be zero, but this time Tesla did quite meaningful amount of restructuring. And we discussed this in a moment, but let's first look at overall operating expenses. So they increased 50% year over year, a massive increase. But I would like to point out Tesla did in the second quarter of last year, Tesla's largest restructuring in Tesla's history. And that, as you can see, caused a temporary or a local low in operating expenses. So for that reason as well, the third quarter of last year is a really, really bad comp. And that's why the year-on-year increase in operating expenses looks so outrageous, because the third quarter of last year was temporarily depressed, let's call it, and the third quarter of this year was inflated by a number of items we'll be discussing in a moment. So the OPEX, so OPEX is short for operating expenses, the OPEX increase was actually much less than what the 50% here implies, after you strip out one-time items. And the CFO talked about it. So he said, largest increase included restructuring and other related to certain actions undertaken to reduce cost and improve efficiency. He was mostly talking about Tesla's alignment in its AI chip efforts. Before, Tesla had basically two programs running. Now they merged it. This obviously caused certain layoffs and other things. This also always involves certain write-offs. And Tesla took all these charges, and there was over 200 million. But then there was more. Then there was also legal expenses and incremental cost incurred for the preparation of the shareholder meeting. So that preparation, it's not really worth talking about it. It involves a lot of advisors and stuff like that to prepare this meeting. I was involved in things like that in my prior career. The bottom line is very costly. This will also reflect some of the cost for drawing up Elon's new comp package and a bunch of other things. Tesla doesn't give us the exact amount, how much that cost, but that was not cheap. But it will not have been a triple million amount. But the key point here is really these are truly one-off items, and we're not going to see it in the fourth quarter. So whatever forecasting you do, you should take these things into account. So you're not extrapolating from 3.43 million. You should be extrapolating from a much lower number. However, I'm not suggesting operating expenses will be dropping to, let's call it 2.3 billion. No, those times are over. And the primary reason is on the next slide. So this chart shows your R&D expenses, so research and development. So this is mostly driven by compensation. And Tesla talked about it. Tesla handed out equity awards to AI researchers. Probably many of you have read about these wild compensation packages elite AI researchers receive. And Tesla will not be immune to that trend in the industry. So they will have to be competitive in terms of compensation. And the CFO basically told us we should expect this to continue to rise. He also told us so in the last quarter. So in my forecasting, I would certainly forecast a further increase in R&D expenses. Next, we look at the other big driver in operating expenses, and this is SG&A expenses. Here you can see they also increased quite a lot. But here you have to keep in mind, this is where Tesla accounts for the legal expenses. The CFO mentioned. We do not know the exact number. I have a rough idea, but I don't want to say it here out loud because you cannot look it up in the SEC filings. But let's just say a little bird told me. But bottom line is this will come out of the numbers in the next quarter, unless of course there's more litigation, whatever. The other item that is included in this number is the cost of running the current robotaxi. There's some cost associated with running the ride-hailing network, although that's a minor drive because most of it will be recognized in up here, cost of revenue here in the service and other things. Tesla did disclose that there was about, I think, 25 million in increased marketing spend in that quarter. But keep in mind that quarter saw a increased activity around the Model 3 Plus launch in China, the Model Y L launch in China, then of course launching the lower cost vehicles in both US and Germany, or in Europe I should say. So that we have to wait and see whether Tesla keeps going with this marketing spend, but this might be launch related incremental marketing spend. So there's also good chances that some of these one-offs will come out in the next quarter. So this, in my forecasting, I have to think about it more. This might come down. But then when we look at R&D expenses and SG&A expenses in terms of how much is it in terms of revenue, because revenue increased to an all-time high, they came actually down. So Tesla is not like overspending. The R&D margins or R&D expense expressed as a percent of revenue came down quite a bit, dropped to 5.8% from 7.1% last quarter. And when we look at the same metric for SG&A expenses, despite the rapid increase, that margin, SG&A margin, came also down by 5.6%. Then the overall operating expense margin decreased to 12.2%, even though there were restructuring charges included. Next, we talk about non-operating items. They used to be kind of a problem in Tesla's earnings because up until the first quarter of this year, in all prior quarters, Tesla did not adjust for the Bitcoin mark-to-market. Mark-to-market means Tesla accounts for the change in value in its Bitcoin value based on observable market prices, even though it doesn't sell anything. So this is just basically a bookkeeping entry. The issue was it did not adjust for it in the adjusted earnings. That created volatility. And after the fourth quarter of 2024, Tesla changed the practice and now is removing, as it should be, the Bitcoin fair value change. So that's why when you look at these non-operating items, you always have to look at them excluding the Bitcoin change. And in the third quarter, that change was much less than it was in the second quarter. In the third quarter, it was only 80 million plus. So that 80 million sits in this 335 million, and the rest was FX changes. So the dollar weakened against some other major currencies, for example, the euro, and Tesla Tesla shows a certain cash balance, but that cash doesn't all sit in the United States. That cash balance is distributed. A lot of it, or a significant share of it, sits in other jurisdictions, and it sits there often in euro or in other currencies. And then when Tesla consolidates its accounts, it has to convert everything into US dollar. And if the US dollar weakens, those, let's say, euros will be converted into more dollars, and the change in dollar from the FX conversion, that is then reflected here in this number. And the bigger Tesla's cash piles grow, the bigger the volatility from these FX changes, provided, of course, there is a relative movement in meaningful currencies. I have a entire separate model just to forecast that aspect of Tesla's numbers, but that's something I will be discussing in the Outlook because it's not really relevant for this presentation. Now we after almost an hour, we got to the profit before tax line. So profit before tax was up 26% quarter over quarter, but down 30% year over year. We already discussed the various one-time effects in the third quarter, so we move on from here. Tesla's tax provision was only, that's a key observation, only down 5%, even though, and if we go back real quick, profit before tax was down 30%. So you see already that the effective tax rate must have increased a lot. And this was actually the case. Tesla's effective tax rate increased from 22% to 7%. That too created a meaningful headwind. I actually posted about this. So if you account for all these one-off factors, and we are almost now at the bottom of the P&L, you could very quickly see, oh, hang on a second, because it was when Tesla reported numbers, immediately everybody reported, oh, Tesla missed earnings, but when you looked carefully, the numbers were much better than what was actually reported by Tesla, and the main reason is Tesla makes hardly any adjustments to its adjusted earnings. Tesla only adjusts for share-based compensation and for Bitcoin, but it does not adjust for restructuring charges or a bunch of other things. A lot of other companies adjust. The best example, if you want to compare, just look at GM. GM adjusts for basically everything to a degree that's almost ridiculous. But I'm getting too much into rabbit hole here. But the point is, I think the underlying EPS, the Tesla reported, was probably, and you can have a debate about it, was probably much closer to 65 cents than to the 50 cents Tesla reported. And depending on what data provider you looked at, Tesla's consensus was at 56 cents. And so basically Tesla actually delivered a beat. And I think this was part of the reason why actually then people came back very quickly and bought the stock, because they realized, oh, hang on a second, if these were one-off effects, if they go away, then actually the extrapolation basis for next quarter, so Q4, is actually much better than what people think. And if you listen to this now and you think, oh no, this is BS, this is really sort of, it's not three-dimensional chess, but basically hedge funds and other investors, they try to think about, okay, how will people think about this, and how will other people think about this to plan their next move. This is how you make money in markets, and not what everybody's thinking. And I think a 8% recovery in the same session from the session low, even though there was absolutely no other material news about Tesla or Elon or anything, basically is a resounding proof for that. So next we get to net income. So it's just profit before tax, less taxes, tax provision, total net income. That came in at just under 1.4 billion, down 36%. Again, number of negative items. And then we look at non-controlling interest, just for completeness. Tesla has a little bit of non-controlling interest that, as you can see, in most quarters, or at least for a long time, was not a needle-moving factor. So there was a deduction of 16 million from earnings. It's just big enough to be annoying that an analyst like myself has to account for it. Then we get to shareholders' net income. So this is GAAP net income. This is before the adjustments that I just mentioned. So that number came in at 1.373 million, so just under 1.4 billion. So very similar to net income, of course, because there's very little non-controlling interest. And then we have to look at the adjustments. So these adjustments came in at 397 million, and that is mostly share-based compensation. There are tax effects associated with that, and then there's Bitcoin. But Bitcoin this quarter only accounted for 80 million of that. But the key point, and I think even a lot of let's call it advanced investors, they don't know that Tesla doesn't adjust for restructuring charges, because adjusting for restructuring charges is like super common. Is I would almost say it's like the default in the corporate world. But philosophies can differ. For example, Amazon does not provide any adjusted numbers. So if you wonder why people provide adjusted numbers, the idea behind adjustments is a good one. The adjusted number gives management to show the market, okay, if you adjust for things that are not ongoing in nature, they were really one-off in nature, this would have been the earnings number. And that is actually very helpful to investors to get a better view about a company's trajectory, prospects, and also importantly, to calculate important valuation metrics. Then we get finally to the elusive adjusted shareholders net income. That came in at 1.77 billion. That was the highest number since last year, but a lot lower than the third quarter of last year for the reasons that we discussed ad nauseum by now. Before we get to EPS, we need to look at the number of shares outstanding. You always should look at them on a diluted basis. This accounts for all dilutive instruments outstanding, and is also the number that is relevant relative to a share price. So please keep in mind that this share price increase looks quite dramatic because the scale is zoomed in quite a bit here just to make the changes more visible. So I'd like to draw your attention to the percentage changes up here. You can see the actual increase is actually by far not as dramatic as the numbers imply. The Tesla share count was up year over year 0.8% in third quarter. This is not super high dilution, but it's also not nothing. Tesla has always been known for generous share-based compensation. This is basically what we see here in these numbers, and this is perhaps one of the biggest sources of strength in Tesla's numbers, and that is Tesla's enormous market cap. Because Tesla's enormous market cap relative to its earnings and business size give it an incredibly valuable currency, and this enables Tesla to pay competitively, even with much cash richer companies like Microsoft, Meta, etc. And that's why it's so incredibly stupid when people argue, Elon tried to bring Tesla's market cap down for this and that reason. This is so moronic. I'm sorry for the rant, but Tesla's market cap is an enormous asset. If Elon had not managed to boost Tesla's market cap to this enormous level, there were periods where Tesla may have gone under because the numbers were not that great. I followed the company since IPO to a level of detail few other people have, and even though Tesla fans will not find this, may find this offensive, but that's the truth. So that's why all this talk about Tesla keeping market cap low is complete bullshit. Tesla's big market cap is an enormous asset, because if the market cap would trade more in line with other companies, the stock would be trading right now, I'm telling you, at $40-50 per share. And to pay people in AI R&D right now competitively would balloon R&D spend to probably $3-4 billion. And that just shows how extremely important and valuable Elon is to the Tesla story. If Elon was to leave Tesla for whatever reason, Tesla would instantly collapse by over 50%. And that's why a debate over whether investors should vote or not vote for Elon is a completely ridiculous one. The answer is, of course, yes. Even if you're amongst the totally disgruntled investors, you should still totally vote for him. In my upcoming outlook, because it's a very important topic, this is also something I will discuss in very great detail and share my thoughts about, what are these scenarios and how investors should best position. But let's move on this presentation because it gets quite long already. Now we get to the adjusted EPS number. That number came in at 50 cents, as I mentioned earlier. That number was down 30% year over year, but again, this was full with one-off items, and my estimate is the actual underlying EPS number was much closer to 65 cents. And then keep in mind the third quarter of last year, the 72 cents was full with one-offs, positive one-offs. So if you take out the negative one-offs in the third quarter of 2025, so this year, and strip out the the positives in the third quarter of last year, you will see that the 72 will come way down, and you would actually think that the third quarter of this year was actually better than last year's. Because quite frankly, when I look at Tesla's third quarter results, okay, people might think, oh, AJ, you're only talking about the one of negatives. What about one of positives? Unfortunately, there is no straight one of positive, at least when I can find in Tesla's number right now. The energy margin looks outrageously high, but management hasn't talked about one-time items, so I don't know. The biggest one-time item, of course, but this is not something we can easily adjust for, is that there was obviously a huge demand pull forward in the US market. But again, we can't look at this in isolation. We look at a couple of other things, but this will be all part of my outlook. Because there will be very important offsets one has to consider. So next we move on from the income statement. Now we move into the world of the cash flow. So here on the right hand side you have now a summarized cash flow statement with the most important positions. And the first main item, we don't have time to discuss all of these items, and frankly I think most people wouldn't be really interested in that. So we talk about the key items. So the first one is operating cash flow. So operating cash flow shows you, okay, from the operating business, excluding any financing activity, excluding any investment activity, how much cash have I taken in, less how much cash I spent to generate that cash, what's left over. That's what operating cash flow will show you. And that number came in almost at an all-time high, just a tiny bit below the prior all-time high at $6.2 billion. And the primary driver was that Tesla sold a lot more cars than it produced. That meant Tesla sold vehicles which it made and paid the cash for last quarter. So that led in the current quarter, so in the third quarter, to a cash release. And that cash release is about $2 billion. In the cash flow statement, you would see this in the line item called inventory. So this next chart shows you a bridge from the cash flow in the second quarter. So if we go back real quick to operating cash flow, so that was 2.5 billion. So that's the 2.5 billion that you see down here, and then the 6.2 billion in the third quarter. And the change to go from the 2.5 to the 6.2 billion is what you see here. So there was a change in operating assets and liability of almost 2.8 billion. This also includes the change in inventory. So this you can see the change in operating assets and liabilities. This is entire bucket here. This also includes receivables. So receivables is something that people owe to Tesla. So customers still need to pay something. And payables, the opposite. Payables is where Tesla owes companies something. So when payables increase, there's actually cash flow positive. And they did increase, but relative to the increase in cost of goods sold, so Tesla's days payable outstanding actually improved. So the Tesla had in the second quarter DPO, so days payable outstanding, so that on average the implied number of days till Tesla pays a supplier of 65 days, and in the third quarter this number dropped to just 52 days. 52 days is broadly average amongst US European automakers, not exceptionally quick, not exceptionally long. The point is, even though payables did increase and did provide a significant benefit, it was not that Tesla tried to boost its free cash flow disproportionately, because the increase in payables, as evidenced by the DPO decrease, was even below what would be proportionally expected. If it was in proportion, then the DPO should have stayed constant. If you're not following, the key point is Tesla did not try to game the cash flow to produce a record cash flow. What this means for the fourth quarter cash flow is also something we'll be discussing in the outlook. So now let's look at the numbers. So first of all, what you want to see in operating cash flow is net income. You want net income to be one of the drivers. This is what we see here. Not a very big driver, but some driver after all, 200 million more. Depreciation is also a high quality driver you're looking for, because depreciation is basically just a deduction you make in the income statement for stuff, for cash that was out potentially many quarters ago. So I consider improvements in operating cash flow that is driven by net income and depreciation very positively. So the two combined almost 400 million extra. Then there was an increase of 28 million in share-based compensation. Here you can have a debate, but let's skip that because overall it's not a big driver, as you can see. So basically how this works is Tesla made a 28 million higher, accounted for a 28 million high expense in the income statement, and because this is reflected in net income, it lowers net income, you have to unwind it in the cash perspective, and that's why it's broken out here. Then we have the change in operating assets liabilities we already talked about. So there was, to just sum up the big items here, so there was a 2 billion positive effect from inventory changes. There was a 1.6 billion positive effect from increase in payables. So that's a positive of 3.6 billion. And then there was a 900 million offset from a increase in receivables. So that gets us to positive 2.9 billion. So the rest to get to the 2.756 billion is a bunch of other plus and minuses. Then there was unwind of deferred taxes. So deferred taxes are taxes that you expect to pay in the future, but you don't have a cash out yet, but you account for it in profit. Then there's the unwind of Bitcoin. And in case you're confused why there is 204 million and not the 80 that I mentioned, the 80 that I mentioned was the value increased recognized in the third quarter. But this view right now, here's a bridge. So it looks at the change in these items. Last quarter, Bitcoin added 280 million, but this was not a cash in, it was a non-cash item. So this inflates the net income. So then in the cash flow perspective, you have to deduct it. And because in the last quarter, this had a negative effect on the cash flow calculation of 280 million, but this time only of 80 million. So the change is negative 200 minus 80 is 200, but it's an unwind, so it's a positive of 200. I think I have to move on because otherwise this presentation turns too much into accounting class, and I don't want to bore the veteran investors who listen to this too much. And then there was some other stuff. So bottom line, very strong cash flow, but by far biggest driver was the inventory unwind. Next, we talk about Tesla's investments or capital expenditures, or short CapEx. CapEx was 2.248 billion. That's down 36% year over year, but third quarter of last year was like all-time high by a huge margin, as you can see. But CapEx was also down 6% sequentially. However, a CFO said this week that Tesla expects 9 billion total CapEx for 2025, and then substantial increase in 2026. So when you look down here, the total for this year amounts to 6.1 billion. That means Tesla expects approximately 2.9 billion in the fourth quarter. I think it's obvious what that is. Tesla most likely brings online a lot of NVIDIA product. A little bit of its AI chips too, but it will be mostly NVIDIA's Blackwell products. And then when you look at these numbers, that will actually be the second highest CapEx ever in a quarter, if the CFO's guidance is correct. The key takeaways, if this comes true, from beginning of 2026, Tesla would have a meaningful amount of additional compute available. Considering Tesla's total investment of about 6.6 billion in AI infrastructure so far, the fact that latest Blackwell generation is much more efficient, etc., I think the incremental capex, or what is implied by the incremental capex in the fourth quarter, could maybe add as much as 25% of current compute, or 25, or somewhere between 20 and 25% of current compute from the first quarter of 2026. That would obviously help to accelerate improvement in FSD, and especially Optimus. Now we come to ultimately long-term the most important metric in any company probably, that is free cash flow. That's really where the rubber hits the road, and Tesla brought in just under 4 billion, 3.99 billion. That is not only an all-time high, but an all-time high by a significant margin. We have to go back all the way to the third quarter of 2022, and please remember that was the period during which Tesla sold at very high auto margins vehicles. I'm jumping real quick to auto gross margin slide. This was a quarter where Tesla had almost 28% gross margin on the auto business. But let's analyze it, what happened. So first of all, free cash flow is operating cash flow minus capital expenditures. And as we just looked at, the operating cash flow was boosted by selling down inventory. So keep that in mind. And then the capex came in a little low by Tesla's current capex spending patterns. If we jump real back real quick back. So Tesla only spent 2.2 billion. OPEX was operating cash flow was 6.2 billion. So the delta is the 4 billion free cash flow. So if we just mentally subtract the inventory release of 2 billion, then we are still at 2 billion of free cash flow. If we adjust mentally for maybe a little bit of low capex, we take out another 500 million. So then we are left with 1.5 billion in free cash flow. That's still a good number in the current environment. So this is basically how I fundamentally think about cash flow. So what are sustainable cash flow drivers considering normal level of investment? So overall, this is still looking very good. You can see that the second quarter was barely free cash flow positive, only 146 million. I think this is not an accident. Actually, Elon said this at least a few times over years. A key steering criteria for him is that he wants to be cash flow positive in all quarters. And that's always something useful to keep in mind when you do any kind of modeling. Next, we look at the financing cash flow. So that looks at all the debt or other securities Tesla may have issued to raise capital, including stock. And also how much was repaid, and the net balance is reflected in this chart. So when the number is positive, Tesla raised more than what it repaid in that quarter. So what you can see in this chart is that in the third quarter, Tesla raised 983 million net. But I'd like to point out that was all non-recourse debt. So the debt is, the debt holders' rights are limited to only specific assets on Tesla's balance sheet. And if these assets have been sort of depleted, these debt holders cannot claim any other things from Tesla. And Tesla's total debt rose to just under 7.5 billion, which is still very, very low. So overall, Tesla has very low debt levels, and it makes complete sense also from a financial engineering perspective, because high debt levels really only make sense if you have a very low PE. But if you have a very, very high PE like Tesla, the loss of earnings on interest expense makes absolutely zero sense. And unless you absolutely need more capital and you can't or don't want to raise capital, there's no reason why you should raise debt capital. And a big part of why Tesla doesn't have any need for debt and why it was able to accumulate so much cash on its balance sheet was Tesla's enormous market cap. Because this enormous market cap enables high share-based compensation while creating relatively small dilution. And that creates basically a permanent equity issuance every quarter. I realize that some people who might be listening to this who are not like knee deep in this topic like I am, they might be thinking right now, this is a little dodgy. In all honesty, it is, but it's just the financial reality of a corporate. But from an investor's perspective, and this is what I all care about, that's a great thing. It's a huge advantage because it means we can pay our researchers, our AI researchers, with a very valuable currency. But again, it all depends on Elon. And that's the only thing everybody always have to keep in mind. There's enormous keyman risk in Tesla, but this is something you cannot price in, otherwise you will never touch the stock. And it's just something you have to accept and move on. So next, let's talk about the cash balance. So it takes a cash balance because of the enormous free cash flow and the positive financing cash flow, the net debt issuance. Cash balance rose to almost 42 billion, 41.6 billion. I think if Tesla continues like that in a few quarters, it will have more cash on the balance sheet than I think pretty much every other automaker, with the exception of Toyota. But let's see. And last but not least, just real quick, here's Tesla's debt balance. As I said, 7.5 billion. This is very, very low. Because again, it doesn't really make very much sense for Tesla to issue a lot of debt. So if we go back to the the cash balance, in the current situation where earnings are not that high, that interest income is actually a meaningful net income contributor. For example, in the third quarter, interest income on this enormous cash balance contributed about 20% of pre-tax income. In other words, just measured by pre-tax profit, Tesla's cash balance is, it sounds a bit weird, but it's effectively one of Tesla's largest business segments by itself. So that's the end of this presentation. I hope this was helpful. I hope to get out my updated outlook for Tesla, including valuation analysis, etc., as soon as I can. And then, of course, there will be periodic app updates as we get deliveries later in the quarter. So stay tuned for that. Thank you very much for listening. See you next one. Bye.